In this week's video, we'll review hard evidence from the markets that show Trump's platform has already significantly altered the investment landscape. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The text in the upper left-hand corner of your screen comes directly from DonaldJTrump.com regarding Trump's platform. Transform America's crumbling infrastructure. Pursue an America's Infrastructure First policy that supports investments in transportation. Refocus government spending on American infrastructure. Before we cover a more direct impact of these bullet points, let's move out to about 30,000 feet. Typically, the government has monetary policy that's engineered by the Fed and fiscal policy that's basically engineered by the president via Congress. In recent years, the markets have been driven almost exclusively by monetary policy. Not much legislation has come out of Washington in recent years that tended to be particularly beneficial for the economy, mainly because not much of anything came out of the gridlock that we had in Washington in recent years. The fact that the markets are moving relative to something other than monetary policy or the Fed is a breath of fresh air. Since Trump was elected, have we seen any direct impact related to these bullet points? A chart over on the right side of our screen here is base metals, or a subset of commodities, relative to the S&P 500. This is a weekly chart, and these are just generic and even-numbered weekly moving averages for illustrative purposes only. You can see before the election here, base metals in the S&P 500 were in a consolidation box, an indecisive consolidation box, and if anything, we were at the top of the box recently, and sometimes we go down and visit the bottom of the box. A visit to the bottom of the box would be bad for base metals relative to the S&P 500. After Trump was elected, the market knows about his platform. What happened after Election Day? The answer is base metals, or DBB, in the ETF world significantly outperformed the S&P 500, and more importantly, looks like it's trying to turn. Over here, we have a full-bore bearish look with blue, the fastest moving average, on the bottom. Now we have a full-bore bullish look with price above all the moving averages and the fastest moving average on top and the slope of all the moving averages. All of them are now positive. Markets look ahead. They're not going to wait for legislation to be passed. They're going to anticipate what may be coming down the pike. Trump's platform specifically talks about investments in transportation. Prior to the election, this is transportation stocks, IYT, relative to the S&P 500 or SPY in the ETF world. You can see for the most part, we've got a long-term downtrend in favor of SPY and against transportation stocks. This is the look here prior to the election. Did the markets react to this bullet point here after the election? The answer is a definitive yes. Everything that we just said over here about base metals relative to the S&P 500 before and after the election pretty much applies to transportation stocks relative to the S&P 500 before and after the election. We have somewhat of a consolidation period down here, and now what appears to be a convincing bullish turn. These can be good risk-reward opportunities in terms of a generic chart pattern because this ratio has not expended a lot of energy yet in this direction. Doesn't tell us whether or not this trend will remain in place, but right now, transportation stocks relative to the S&P 500 from a probability perspective look a lot better here than they did here, here, or even here. there any way for us to indirectly measure conviction or the confidence behind these moves here? The answer is yes. We can look at trading volume. If this move here occurred on very light volume, we wouldn't be as confident in the breakout, but that's not what happened. November 10th, Twitter, base metals such as copper continue to show signs of strength. On November 10th, the close, the copper ETF, which is a base metal, JJC, it normally trades about 35,000 shares a day. It was up over 4% on way above average volume. Instead of 35,000 shares, 121,000 shares. How about the move in transportation stocks relative to the S&P 500? Same situation. IYT normally trades on an average day 268,000 shares. This week after election day, 533,000, 842,000, and 579,000. So this vertical-like turn here and bullish move occurred on very, very strong trading volume. If you follow the markets closely or work on Wall Street, you know that Dodd-Frank is basically the regulations for the financial industry that followed the financial crisis. This is an NPR title. Trump team promises to dismantle Dodd-Frank bank regulations. Politico, Trump's budget making the deficit great again. Here's regional banks, KRE. It's a weekly chart again with our same generic for illustrative purposes only, even numbered weekly moving averages relative to SPY here. This is a relative chart. Before the election, you can see we have some consolidation and confusion here. Heading into the election, if we know this and Trump wins, dismantling bank regulations typically would be good for banks. Takes a burden off of them, allows them to focus on their primary task at hand, and it also allows them most likely to take more risk if these regulations are dismantled. It also takes a huge burden off of what can be an unproductive department. Their compliance departments don't typically add to earnings per share. How could deficit spending harm or help banks? Well, if you run deficits, it tends to lead to higher interest rates. And over the long haul, banks would prefer to have higher interest rates since they make money on interest rate spreads. So this is regional banks versus the S&P 500 before the election. Did the market react to these two planks in Trump's platform? The answer is a definitive yes. We've got a nice bullish turn here and a very strong and convincing move out of this consolidation area here. And we also went on to make a new high above the ratio's high from late 2015. We've got a full bore bearish look here, and now we've converted to a full bore bullish look on the weekly chart of regional banks relative to the S&P 500. Other than the slope of this line, do we have any other way to measure the conviction of this move? Indirectly, we can use volume. The day after the election on November 9th, this is a tweet from 2:14 p.m., so during the trading session. On that day, XLF, the financial sector spider, which is also banks for the most part, and financial services companies, was up over 4% on huge volume. It normally trades about 50 million shares a day. At 2:14, it had already traded 192 million shares relative to that average day of only 50 million shares. We got follow through the next day. This is a tweet with about a half hour left in trading on November 10th. KBE in this instance was up over 4% on massive volume. It normally trades about 3 million shares At 322, it already traded over 10 million shares, or roughly 3 times an average full session. It's a tweet from Friday afternoon from Trader Stewie. What drove this strong move up in small caps? IWM, the small cap ETF, was up $3 on Friday, and you can see it cleared this consolidation area here and went on to make a new high. In terms of Trump's possible impact on small caps, again, directly from Trump's website, his platform, reform the entire regulatory code to ensure that we keep jobs and wealth in America. He also plans to lower business tax rates and repeal and replace, or at least alter, Obamacare. All of these things could be positives for smaller companies. Like the other examples, these green bars here are volume. Notice how high volume was after the election here. So this move here is backed by very, very convincing trading volume. Remember, Politico said that Trump's budget might make the deficit great again. Deficit spending impacts interest rates from numerous perspectives. One way is deficit spending can help GDP and earnings, so when the economy is stronger, it's easier for the Fed to raise interest rates. When you raise interest rates, that tends to be bad for bonds. And deficit spending also impacts default risk relative to treasuries. So if we just spend and spend and spend and spend, and investors believe it's possible that we might default and they might not get their principal back, then they're going to require a higher interest rate to compensate for rising default risks. This is Treasury bonds, TLT, relative to the S&P 500 before the election. This is January of 2016 here. You can see, like many markets, this ratio was very, very indecisive and kind of moving sideways for several months. TLT came down relative to SPY and found some support at the bottom of the box. Then it went into a smaller box support here, then it rallied. And before the election, TLT, SPY, the ratio started to rally in favor of TLT. How does this same ratio look after the election? Quite a bit worse. So now what once was support may now act as resistance. Treasury bonds significantly underperformed the stock market following the election. This is the ratio as of 3:18 p.m. on Friday, November 11th. This big down move here against treasuries also occurred on very, very strong volume. TLT typically trades about 8.7 million shares a day. After the election, 31 million shares. November 10th, 22 million. And on Friday, over 9 million. So this is a convincing move here from a volume perspective as well. And we've broken out of a multiple month consolidation box. The longer you go sideways, the bigger the move that you expect to get when you break out either in a bearish manner, break down, or break out in a bullish manner. In this case, right now we have a bearish breakdown. Is it possible after a move like this that treasury bonds bounce relative to stocks? Absolutely, positively, yes. This ratio might want to come back and retest one or both of these lines. As always, no forecasting under our method. We'll take it day by day. We make decisions based upon what's in front of us. This is what's in front of us right now. I think it's valuable for clients to hear interpretations from other experienced professionals from time to time. In this case, CFA Ben Carlson. This comes from a wealthofcommonsense.com. You could Google this title to find it. Could a Trump presidency lead to a stock market bubble? Here's the main point I wanted to highlight from Ben's post. The recession crash scenario is certainly one to consider, meaning if Trump is elected. But there's one scenario not many people will be talking about. It's possible that within the next couple of years, we could see a melt up in the markets. And he's really referring to risk markets or the stock market. Then he goes on to say that Trump has stated numerous times that he plans on doing massive infrastructure spending. He's always promised tax cuts, and he's not afraid of large budget deficits. If anything like this were to happen, we could see much higher corporate profits and higher inflation. When the government spends money and builds bridges and fixes airports, they're going to be hiring private firms to do that. The government will be writing checks to companies to implement these infrastructure projects, which can help GDP and earnings. Obviously, you're running deficits when you do that. There's no such thing as a free lunch, and that'll tend to lead to higher inflation as well. How you get the melt up in the markets, too, is if you have higher inflation, higher GDP, and higher earnings, and bonds significantly underperforming stocks, it's possible that we could see that shift where money coming out of bonds starts to migrate over to more growth-oriented investments. A lot of money has been parked in bonds in recent years. He's saying we could see a massive shift in investor allocation preferences, which could potentially take the stock market into bubble territory. Ben is by no means saying this is the only possible outcome. This is one possible outcome. Have we covered anything in recent weeks that might align with a stock market bubble or a melt up or a bigger than expected move in the investment markets? Yes, remember back on August 19th, we had the video, "This signal has only occurred 10 times in the past 35 years." You can find the video by Googling this title here with my last name, Shavako. Here's an example of those 3 weekly moving averages that were used in that analysis. This is the bullish turn in 2010. And remember, last week, before the election, we gave an update on this look and said that we still had a full-bore bullish look. And as long as we had that look, even heading into election week, there were reasons to try to be patient and say this here on November 4th looks a lot better from a risk-reward perspective than what we had in late December of last year. And with the S&P 500 rallying sharply on the week of the election, of course, we still have a full-bore bullish look on this chart a week later. If we apply those same weekly moving averages, the 30, 40, and 50, to regional banks, we can learn something about the broader market as well. We know we've been going sideways in an indecisive manner for a long time. Regional banks, when the Fed was talking about raising rates and then changing their mind, banks were all over the place because they're interest rate sensitive, but they basically went nowhere within the orange box that dates back unbelievably to 2013. Regional banks have been in this long-term consolidation box for over 3 years. This is before the election. How does this weekly chart look after the election on November 11th? The weekly candle shows strong buying power, and KRE was able to break out of the long-term consolidation box. It also has a favorable look with our 3 for illustrative purposes only moving averages. When we have a more favorable long-term market profile like we do today, relative to, let's say, the more concerning profile in late December, early January of this year, this quote applies. Reminiscences of a stock operator. This is Jesse Livermore, the original tape reader. At least that's the way history records it. He says, "It was never my thinking that made big money for me. It was always my sitting." Got that? My sitting tight. When in doubt, if things look good, trend is still intact, and it looks like a bull market, when in doubt, we try to sit tight. When the data deteriorates and we hit volatility to respect, then we take action. As we noted on Short Takes on election night, sometimes the initial reaction in the markets doesn't match the longer-term reaction. This is the S&P 500 on election night when the market started to realize that Trump might be victorious. The futures plunged. There's a waterfall decline here from 2152. Went limit down at one point. The low was 2028. So they dropped well over 100 points on the S&P futures. Anecdotally, when S&P 500 futures go limit down as they did on election night, often that's a buying opportunity. And in this case, it did turn out to be a buying opportunity in the futures market. This is on election night, well before the markets opened the following day. When this happened, I thought about this quote from the book, The Market Wizards. The fact that the market does not follow through much on these fears, the fears of really bad things happening overnight if you are long stocks, strongly suggest that there must be some very powerful underlying forces in favor of the direction of the original position. And it is a good rule of thumb. If you have a position overnight that you think you're going to have to sell or monitor in the morning, and then for some reason it's green the next day, typically that's a very good sign for your position. And instead of selling on the open, sometimes it's better to add to the position when something like this happens. We do have a few positions, our weaker sisters, that we'll be watching closely, and we have been watching them closely. SLV here has come back to an upward sloping 200-day moving average, and now it's at the 50% retracement level here. As long as we can stay in this general area here, it still looks like a pullback within the context of an ongoing uptrend. But the math has deteriorated in such a way that relative to other opportunities, SLV will be on a short leash heading into next week. Same thing can be said for GLD. Right now, we've got the A to B move, and as of Friday, November 11th, we've moved back to the 50% retracement. We still have an upward sloping 200-day, but it's starting to flatten out a little bit, so GLD also will be on a short leash. We'll keep an open mind about what happens next week. Some more favorable charts here. SPY, did our patience pay off over the past few weeks? The answer is yes. It was up 3.79%, is back above all of the fibs that we've been looking at, and an upward sloping 200-day. Same thing can be said for RSP, an equal weight Friday, November 11th. It's also nice to see that an equal weight S&P 500 actually outperformed SPY. This, RSP, was up 4.52% relative to SPY's 3.79. The slope of our 200-day for RSP really doesn't look anything like this higher risk period in late 2007. Similar situation for the total stock market. VTI is much broader than the S&P 500. It's good to see that VTI outperformed SPY during election week. VTI was up 4.33%, which is greater than SPY's 3.79. As it was in the past few weeks, we still have a try to be patient with these positions look. We also know as of November 11th, as we noted last week, this, the present day, looks a lot more like this favorable turn here in 2009 than this unfavorable turn in the 200-day in late 2007. We've noted in recent videos, in fact, we covered this chart on October 28th, and we said this turn in inflation expectations is similar to this bullish turn here in 2009. This period was favorable for risk assets, especially relative to bonds. How does the same chart look after the election? This is before the election. It still has a bullish slant. This type of move here is similar to this type of move here, and after this, good things happened in risk assets. If If we zoom in after the election, we had this consolidation in the ratio, and now we have what looks like a convincing breakout. The CCM market model leverages the concept of risk-on, risk-off ratios or inter-market analysis to help us understand risk and reward. This is a risk-on, risk-off ratio. This is XRT retail stocks relative to more defensive-oriented treasuries. The point of the exercise on all these charts, the reason why we're looking at 2008, it's helpful to understand what maximum fear looks like. This is what maximum fear looks like. It's a full bore bearish look with blue, the fastest moving average on the bottom, price below all of the moving averages, and the slopes of all of them are down. It's also helpful to understand what a bullish turn looks like. It's almost the mirror image of this. Now in 2009, when the stock market bottoms, we get a full bore bullish look with price above all of the moving averages. Blue is on top, the fastest moving average, and the slopes of all of them are up. We can learn something about risk and reward in the present day by looking at this ratio in the present day and asking, does it look more like this favorable period here, or does it look more like maximum fear here in November of 2008? As of Friday, November 11th, it's easy to see that it looks a lot more like this bullish turn here, where we have a tight cluster of moving averages, blue on top, a tight cluster of moving averages with blue on top, and price pops above it in a convincing manner. Price pops above it in a convincing manner. This is a longer term analysis. It doesn't necessarily tell us what's going to happen over the next few days, but it does help us with probabilities looking out weeks, months, and maybe even years in some cases. How about base metals, commodities relative to defensive-oriented treasuries? Same consideration. This is what fear looks like here in 2008. This is what a favorable turn looks like. There's no question that this ratio here looks a lot more like this favorable and bullish turn in 2009 than this unfavorable and high risk period and maximum fear period in 2008. There's numerous ways to look at risk on, risk off, or intermarket analysis. In this case, we're looking at small caps, IWM, relative to long-term treasuries, or TLT. This is our fear look. This is our confidence turning look. The present day chart has morphed from a full bore bearish look early in 2016. Early in 2016, this looks like the early stages of a bear market. Now we've morphed into a full bore bullish look here. There's no question that this looks a lot more like this period here than this period here. All it does is help us with probabilities. Credit markets can help us as well. This is higher yielding. I'll search for higher yield because I'm not concerned about default risk, JNK, relative to. I am concerned about default risk, and I'd rather take a lower coupon and trade that for safety of principal. This is what fear looks like in 2008. This is what a confident turn looks like when fear of default starts to drop. The present day had a consolidation look, and it's moved from a full bore bearish look earlier in the year to a full bore bullish look on November 11th. Risk on, risk off, a basket of stocks, SPY, relative to a diversified basket of bonds, AGG. Here's our fear look in 2008. The probability of bad things happening was higher here than it was here. After this, bad things did happen. The probability of good things happening is higher in here than it was here. And indeed, good things did happen. 2016 looks a lot like this period here. You have somewhat of a consolidation and a breakout here in 2016. You have somewhat of a consolidation and a breakout here in calendar year 2009. Like the other charts earlier in the year, this is a full bore bearish look here in 2016, and it has now morphed into a full bore bullish look, telling us that the odds now favor stocks over bonds. Materials stocks should benefit from infrastructure projects and government spending relative to treasuries that may not benefit from higher deficits and higher inflation. This is fear. This is a confident turn. We have a tight cluster of moving averages and a lot of indecisiveness in here, and this is why the market model tends to struggle. The market model doesn't like indecisiveness. It likes conviction. This is conviction. It's easy to measure. This is what bearish conviction looks like. This is bullish conviction. It's easy to measure. This is bullish conviction. It's easy to measure and easy to see. Full bore bullish look now, previously a full bore bearish look. The longer we go sideways, the bigger the move that we can expect to get when we either get a bullish breakout or a bearish breakdown. Psychologically, we can learn something by looking at long versus short. I'd rather be long here in the spring of 2007 from a probability perspective, but in October, November, December, the odds shift to now a full bore bearish look, telling us that it's more favorable from a longer term perspective to short the Dow than own long with DIA. Here's the bullish turn. This is what fear looks like. This is what confidence looks like. This is what the present day looks like. Consolidation, consolidation, a breakout here. After you move, the market needs to consolidate its gains. You move sideways for several months. This is a bullish look here. Full bore bearish look earlier in the year has morphed into a full bore bullish look. This looks more like this period here than any of these periods here. A fair question might be, when you're comparing stocks versus bonds, the Fed's about to raise interest rates. Doesn't that enter the picture? Yes, it does enter the picture. And typically when the Fed's about to raise interest rates, it means good things might happen for the economy. But let's take bonds out of the equation. It's a fair question. So in this case, we don't have bonds in the equation. We're looking at the total stock market relative to defensive-oriented consumer staples. Similar situation. This is what maximum fear looks like. This is what a confident turn looks like. And this is what the present day looks like. We have a full bore bullish look presently and a nice convincing move here. Earlier in the year, we had indecisiveness and a full bore bearish look. Here's another take on the outcome of the election and investing. Stanley Druckenmiller, we've talked about him before. He's been very, very successful for a long period of time. He was profiled in the book Market Wizards. His take: the economy is so overregulated and people are just drowning in red tape that the removal of that, and I'm also expecting serious tax reform, cuts to the corporate tax rate, etc. Therefore, I'm quite optimistic on the economy. I have a large bet on economic growth. Druckenmiller, like the market model, will only maintain that bet on economic growth as long as the data that he has in hand and the story that he has in hand aligns with that bet. If the data that we have in hand changes, then we're going to have to make some adjustments. If we look at the facts and say, does it still look like economic growth, then we should try to remain invested and more like buy and hold investors as long as the odds are in our favor. We have to keep in mind our personal biases relative to candidates or political parties under our system is 100% irrelevant. Markets set asset prices. The market's opinion of policy and the outcome of the election is the only opinion that will impact our bottom line. Personal opinions have little to no impact. This November 11th article on CNBC.com had a handy little bar graph here. Election day may have been a turning point for investment strategy. Since election day, you can see we have a risk-on bias. Financials, industrials, materials, energy, S&P 500, some of the laggards, defensive utilities, defensive consumer staples, yield-oriented REITs, tech, and yield-oriented telecommunication stocks. These are more defensive positions here, and these are more growth-oriented positions here. This tells us a lot about the market's longer-term read potentially on the election. Here's another quote from Market Wizards that's incredibly important within the context of having those favorable longer-term market profiles. I think to be viable, a trend-following system has to be medium to longer term. You have to maintain a longer-term focus as long as the data looks good. The only way we can monitor the data properly is to head into next week with that flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.